Are you concerned about the impact of Budget 2024 on your wealth? The higher inclusion rate on capital gains hurts if you own a private corporation or face significant capital gains from selling property or a deemed disposition. At Taxevity Insurance, we specialize in life insurance strategies for wealth protection and optimization. I'm Pramod.
And I'm Jeevan.
Today, we'll discuss ways to address these tax challenges, whether you're an advisor seeking solutions for your clients or an individual wanting to optimize your wealth. Let's get started. Here is the agenda we'll be covering. We are now navigating a new tax landscape. A smart tax system rewards responsibility and economic growth. Responsibility is about protecting against risks. This is a reason why most forms of insurance provide a tax-free payout. Saving for tomorrow is also important, and that's why we get tax deductions or tax-free growth with vehicles like RRSPs and TFSAs. Finally, economic growth is essential, and this involves taking prudent risks. As a reward, tax rates are lower for private corporations, flow-through shares, and capital gains. Capital gains are the profits you make when you sell a capital asset for more than you paid for it. There are many sources of capital gains, ranging from stocks, real estate outside your principal residence, businesses, collectibles, etc. To reward risk-taking, capital gains have been taxed favorably. We used to have an inclusion rate of 50%, which meant that only half of your capital gains were taxed. This applied equally to individuals, trusts, and private corporations. Under the new rules, the 50% only applies to individuals on capital gains up to $250,000. For larger capital gains, individuals have an inclusion rate of 67% on the excess. This is an increase of 33%. For trusts and corporations, the 67% applies on every dollar, which reduces the untaxed portion to only 33%. How can you eliminate capital gains? We'll look at two ways. The first is philanthropy. Rather than selling assets with capital gains, you can donate them to a charity or your donor-advised fund. The charity sells those assets immediately. The buyer gives the fair market value in cash to the charity. You receive two benefits: a donation tax receipt and the elimination of the capital gains tax you would have paid if you sold the assets yourself.
Another way to eliminate taxation on capital gains is to invest in other tax-favored vehicles. For instance, with an RRSP or TFSA, while there may be capital gains occurring inside of these vehicles, you're not actually being taxed on them. It doesn't really matter if you're earning interest or capital gains or dividends. You're not experiencing the taxation downside. Inside of a corporation, IPPs would be an example of the same concept. And in both places, cash value life insurance also has the same advantage.
Let's look at building wealth with tax-smart strategies, starting with an understanding of how life insurance works.
At its core, an insurance policy is a promise from a life insurance company to pay out a death benefit if, while the policy is active, the life insured passes away. So with term insurance, that would be your term 10, 20, 30, etc. You would pay a life insurance company, and if you were to pass away, a tax-free death benefit would be paid out to your beneficiaries, or in a corporate situation, to the corporation for distribution. There exist other vehicles beyond term insurance where you can put in more than what is required to simply keep the policy going. These would be whole life and universal life insurance. So here what happens is any quote-unquote extra deposits go into a tax-sheltered fund where over time, tax-sheltered compound investment growth occurs. There is also Term 100 insurance, which is permanent despite the name. The 100 really refers to the fact that premiums stop at age 100, but the coverage lasts until the life insured passes away. While it is permanent, there is no growth component to it, so it can be heavily eroded by inflation. With whole life and universal life insurance with proper structuring, this isn't so much the case. They're more like an enhanced tax-free savings account which allow for much larger contributions and, importantly, can use low-taxed corporate dollars. We also get asked if there's any opportunity to access the funds that have been invested in whole life or universal life insurance, and the answer is yes. There are several ways. The most common and typically the best is to take a collateral loan against the policy. Withdrawals are typically taxable, and policy loans have several drawbacks as well as restrictions. To compare them, a TFSA is simple in structure, but it has low limits and cannot use corporate dollars. Whereas with life insurance, while it can be a powerful tool, you first must qualify medically, financially, and also have the correct lifestyle. So what we mean by that is that if you are a very adventurous person, for example, if you're regularly going scuba diving or mountain climbing, that could exclude you from getting life insurance or have those activities excluded in your policy. The other consideration is that premiums increase with age. So a younger person who may be able to better qualify for life insurance may not be able to afford it, while someone who's older may have the money available but may not be able to qualify.
Now we'll look at strategies for business owners and incorporated professionals. For those who are incorporated, including doctors, life insurance offers even more specialized strategies. These can help you offset the impact of the increased capital gains tax while providing both protection and long-term financial benefits. Let's explore corporate tax rates and strategies. In Ontario, active business income is taxed at 12.2% up to the small business deduction, typically $500,000, and 26.5% above. These low tax rates create an incentive to retain earnings inside the corporation. But when these dollars get invested, over half the passive investment income gets taxed. Fortunately, this tax does not apply to investment growth inside cash value life insurance. This is a reason to put some retained earnings into whole life or universal life. There's another problem. Under the guise of tax fairness, passive investment income can now affect the tax rate on active business income.
Previously, the small business deduction was always $500,000. Now, if you earn more than $50,000 of passive investment income annually inside of your corporation, you are taxed more punitively on your active business income. For each additional dollar that you earn passively, your small business deduction is clawed back by $5. This means that if you were to earn $150,000 of passive income, every dollar of active business income would get taxed at 26.5% rather than 12.2%. Between $50,000 and $150,000 of passive income, there is a sliding scale. What can you do?
There are a couple of options that we'll look at. An individual pension plan is one. This is a defined benefit pension plan for one person. An IPP allows larger contributions than an RRSP, which can be attractive for people who are older and have higher income. The corporate contributions are tax deductible. While that's attractive, corporate tax rates are quite low, which means the tax savings are small. The investment growth is tax sheltered, and the benefits that come out of an IPP are taxable.
Cash value life insurance is another option that we were looking at. And it has an advantage when it comes to retirement as well, in that it can be used to supplement a retirement plan. It's important to note, however, that life insurance is not meant to provide all of someone's retirement income. It's merely meant to enhance it. So if someone had a permanent life policy that they purchased, say, 20 years ago, and the cash value has appreciated considerably, they could assign that policy to a lender as collateral for a secured line of credit. The funds can then be accessed however they want. And here's the interesting part. The interest on that loan can often be capitalized, which means it's added to the loan balance instead of being repaid while the person is alive. What would then happen is, with, again, proper structuring, the tax-free death benefit could repay the entirety of the loan, and anything left over would then go to beneficiaries. In this way, the tax benefits of permanent life insurance are used while the person is alive. It provides them income, and it's not restricting their cash flow either.
In comparison, an individual pension plan gives tax deductions now but creates taxable income later, and a corporate insured retirement plan gives tax-free income later but does not give tax deductions now. Each has pros and cons. We'll now look at a case study.
Yeah, so we're looking at two doctors who are married. The husband is 43, the wife is 37. Both are incorporated. They're both not smokers in good health with two young children. They have an outstanding mortgage of $500,000 on a $2 million home. If he passed away, she would need $500,000 of income replacement to support the family for a number of years. I believe in this case it was for 5 years. And if she passed away, he would need $250,000. The difference is because he earns materially more than she does. They also want to invest more corporately. In this situation, the first thing we wanted to do was address their immediate need of repaying that mortgage, as well as replacing any income that could be lost if one of them passed away. So in the case of the husband, that would work out to be $1 million of coverage on him. That's how much his wife would require if he were to pass away. We looked at term 10 and term 20. That's what they were interested in. And between those two options, they eventually chose the term 20. For the wife, it was the same thing, just a smaller amount. When it came to them wanting to invest corporately, we looked at a few options. They wanted a product that had some investment choices, which meant that it was universal life that we were looking at. Whole life is a very powerful product, but there are no investment choices at all. There's only one fund that all the investments go into, and that's that. So with universal life insurance and whole life insurance, ultimately what happens is you put in a premium for a number of years. In this case, they wanted to prepay everything within 10 years. So you can see on this chart here that after 10 years, there's nothing else going into the policy from their side. Then you have an increase in cash value and death benefit. So at life expectancy, which would be around her age, 87, that's what we're looking at, there would be a cash value of about 1.6 million, a death benefit of about 2.2 million, and an after-tax return, if we compare it to a traditional investment, of 4.85%, which is pretty good. With this cash value, because they also wanted the ability to do something with this policy while they were alive, they could have used it, say, at year 30 to create that corporately owned insured retirement plan that we were discussing. Or it could have been at year 40 or year 20, something along those lines. And in this case, because most of the taxes are owed on the second death, we're using a structure called joint last to die, which means that the death benefit is paid out on the second death. This is a lower risk to an insurance company, which means that the premiums required to keep the policy going are lower. So more of the $25,000 going in annually for the first 10 years is going towards the investment portion rather than going to the administration of the policy. You might have noticed on this slide that there is something called the net death benefit. This is something that only applies in corporate cases. With a personal situation, what would happen on death is that the benefit would simply be paid directly to beneficiaries. Inside of a corporation, it's slightly different. There's something called the capital dividend account used. What happens here is that when a death benefit is payable, all of it goes tax-free to the corporation. But it's, generally speaking, not where the death benefit needs to ultimately be. How is that death benefit passed through the corporation? So there's two components here. The first is the ACB. Over time, it eventually becomes zero. It's the cumulative premiums minus the cumulative net cost of pure insurance. We're not going to touch on them too much more here. So anything up to this adjusted cost basis, which is typically a small portion of the entire death benefit, say up to maybe 20 or 30% in the early years, that would come out as taxable dividends to shareholders. Anything above that generates a CDA credit, and that portion of the death benefit goes into the capital dividend account and is then paid out via tax-free capital dividends. This is the same account that the untaxable portion of capital gains goes into as well, which now would be 33% rather than 50%. To break it down on a numerical level, here we can see that after 40 years have passed for this couple, there is no more taxation on any part of their death benefit. meaning that all of it can pass through the corporation tax-free. But you can see that in earlier years, there is a sometimes substantial amount of tax that needs to be paid, but it's still dwarfed by the entire death benefit available. So the benefits of allocating some retained earnings to whole life or universal life insurance are, first of all, the immediate benefits of escaping the 50.17% tax rate on passive investment income, as well as helping preserve the small business deduction, which is that 12.2% tax rate on active business income, particularly if there is more than $50,000 of passive investment income inside of a business. There are the future options, which would be using the cash value to open a tax-free line of credit, or simply to take a one-time tax-free loan, depending on someone's situation, which could be used to either invest or to supplement retirement income. Finally, there are the estate benefits when the death benefit is extracted via the CDA, and this provides cash to pay the taxes from the deemed disposition on death of the life insured personally.
Protecting your legacy is what we're going to look at now. Canada has a deemed disposition at death. You are taxed as if you sold all your assets the day before you died. You're deemed to have sold all your investments and even the family cottage. You're also deemed to have taken every penny out of your RRSP or RIF. You can transfer some assets to your surviving spouse. This defers the tax until their death, but does not eliminate the tax. The deemed disposition is a reason why you could have a capital gain above $250,000 and be required to include 2/3 of the excess in your taxable income. Let's look at an example. Let's say there's a family cottage that cost $250,000 including improvements. The market value is now $1 million. That means the capital gain is $750,000. In the old days, the taxable income would be half of that, $375,000. Now, with the new formula, the taxable income is much more, $458,000, which is an increase of over $83,000 or 22%. There are strategies to deal with the deemed disposition. One is to donate securities, as we talked about earlier. This provides a way to reduce the tax bill, but does not give the cash to actually pay the taxes. Another classic solution is permanent life insurance. It provides quick tax-free cash to help pay the taxes and other benefits. Since Budget 2024, we've been getting numerous questions from advisors and individuals about life insurance strategies that may help with the new tax changes. We'll answer some common ones now. If your question isn't covered here, please reach out to us directly. First question, I'm not incorporated. Does life insurance still make sense for me in light of these tax changes?
Many would say yes, it still does make sense because of the taxes arising from anyone's death. Permanent life insurance is already being used to provide quick cash without forcing the sale of assets, whether it's personally or corporately owned. Even without the additional benefits of corporate ownership, permanent life insurance generally costs less than your expected tax bill if you are healthy when you apply for coverage, and in some cases, even if you are in substandard health, particularly if you have a healthy spouse that you could apply with. Another question we've received is, I already have some life insurance. Is that enough, or should I consider more?
Congratulations on having some planning in place. Whenever significant changes occur, whether personal or tax related, reviewing your coverage is wise. If you got life insurance years ago, you may find you have too much or too little. Updating your financial plan is a good place to start. Another question. Aren't insurance premiums expensive, especially as I get older?
Insurance premiums are based on factors like your age and health. That's why getting coverage sooner is better. For estate planning, as we looked at in our case study, there's a version called Joint Last to Die, which covers both you and your spouse. This structure pays out at the time of the second death when most tax is usually due. The premiums are usually lower than single life coverage and have the advantage of potentially covering someone who's uninsurable, provided that the spouse is insurable. Ultimately, expensive is a question of value and is easier to evaluate by looking at realistic projections. My clients are getting pitches to buy more insurance before the higher capital gains tax takes effect. Your thoughts?
Your clients are wise to contact you before acting on impulse. Deciding on the right amount and type of life insurance takes time and careful analysis. Updating their overall financial plan to reflect the Budget 2024 changes is a good starting point. We're happy to partner with you to evaluate these pitches and determine what's truly in your client's best interests. Another question. I'm thinking of leaving Canada. How would life insurance help me?
This is a fairly niche situation. We were tempted to leave too, but ultimately we decided we liked being in Canada. Becoming a non-resident can have significant tax implications because there is a deemed disposition when you emigrate. You're taxed as if you sold all of your assets just before leaving. Do talk to your tax advisor. Life insurance may play a role in your exit planning strategy, but it requires a tailored approach. Another question. Could the tax rules for life insurance change?
Yes, they can, but they rarely do. Major changes took place in 2017. Prior to that, major changes took place in 1982, which is quite a big gap in years. While we cannot predict the future, tax rules are always subject to change. One advantage of acting sooner is that policies already in force are often grandfathered if rules change. Tailored solutions, secure future. Budget 2024 changed the rules, but that doesn't mean your wealth protection has to falter. Navigating ongoing tax changes demands vigilance. Advisors, let's collaborate. Contact us to explore how our optimized life insurance strategies can empower you to offer even greater value to your clients. Doctors, business owners, and other Canadians concerned about the future of your wealth. If you want clarity on how these tax changes impact you and your legacy, we're here to help. Visit Taxevity.com or reach out directly. It's time to explore how life insurance can offer both protection and opportunity. Is there anything you would like to add, Jeevan?
All I'd like to say is thank you for your time.
Bye.
Bye.